Let's kick off. Why is having your own balance sheet intrinsically more virtuous? Because effectively, whenever I talk to balance sheet lenders, there is an element of kind of virtue that creeps in, which says, because it's our money and we do it ourselves, and and marketplace is other people's money, so they're intrinsically kind of they've got a series of behavioural skews. But I don't really understand why, if you've got your own balance sheet, you're actually going to be any different. Why? I mean, explain that to us. Don't tell us that it's simply because it's your money and therefore you care about it. Because I presume that most of the marketplace lenders care about their investors' money as well. And they're not going to deliberately go and stick it into some old rubbish, because otherwise it would destroy their performance record, won't it? And they won't get any more money. So I don't understand. Why is it so much more beneficial to have a balance sheet model?
Well, I'll jump in. So I'm Lou. I run capital markets at OnDeck. So we're pretty large issuer, originator in the small business loan space. So I guess to correct you to begin with, even when you think about balance sheet, it's not all my money either, right? So if you think you still borrow from banks.
It's still someone else's money.
So we own the credit risk of it, and we hold the first loss. But nevertheless, we do borrow against our assets. I mean, I think when it comes down to it, it's not so much it's magical about balance sheet side of the business. And I think to us, it's just much more about diversification of your investor base. And the way we look at the universe, whether it's balance sheet or marketplace, it's just different ways of financing yourself. Yeah. As an originator, I've been in capital markets for a long time. You do go through markets ups and downs, and assets fall in and out of flavor. I think different institution focus on different assets during different period of time. So I think somebody else on the previous panel said it very clearly. I mean, there are a lot of investors has a herd mentality as well in terms of assets. So beginning part of this year, we clearly have seen that 2 years, last year there was a tremendous amount of demand for assets on the marketplace, lending, buying assets, and something happens in the market and there's a disruption that happens in the market. So to us, it's just really about diversifications. We like the assets we originate, so we don't sell 100% of our assets just because we really do like the assets we originate. Marketplace lending is really a form of attracting other form of investors other than banks and insurance companies and money market managers that will lend us money at very low yield. But I think marketplace lending attracts just a different profile of investors that like to get exposure to our asset class, but have higher risk tolerance and higher demand. So I think makes us a much more stable platform over time.
I'll just hop in. By the way, I'm Michael Finkelstein, the CEO of the Credit Junction. For those of you who don't know us, we're the first data-driven asset-based lender, and we primarily make loans from $500,000 to $5 million. All of our loans are lines of credit. So from day one, it made sense completely to be a balance sheet lender, given the fact that the way we structure our deals, there's an initial advance, and then you can grow into more capacity. So I think part of it is also what loan products you're offering, how frequently you're potentially funding the same borrowers, and the ability to have a balance sheet at that point, besides all the things that we know about with the alignment of risk and different kind of investors' threshold for hurdle, made sense for us. So I think part of it is also what are you offering in the market that suits your loan product specifically.
Andy, let's come in.
Yeah, it's also, I'm Andy Whelan from GLA Finance. We are a UK-listed trading business which has niche businesses that we own outright, that do lending. And obviously we also have an investment vehicle where we're investors in other businesses such as the Credit Junction with Michael. So for us, I think balance sheet lending is quite an interesting statement because we're a hybrid model. We have our own balance sheet.
In fact, quite a few are hybrid, actually, aren't you?
Correct.
Yeah.
And then what you also have is we, in effect, syndicate loans.
Yeah.
And I think the balance sheet is very important for two reasons. One is, yes, it's other people's money, I take that, it's investors' money. But it allows you to underwrite loans. It means you can act very quickly, which is what the borrower's real criteria is. It's speed. Speed is quite important in this world. The banks have become they were a bit more before, but they're so slow to respond, and it kills the business.
I was actually going to ask that. Actually, I was going to ask that with Jeremiah in the keynote first in the afternoon. To what degree do a lot of your customers, I think, without exception, are all businesses, do they care about the yield? Do they care about speed of access and ability to get stuff? Are they willing to pay a % or two extra, a couple of 100 basis points, just to get streamlined decision making? And is that your experience?
Yeah, it's my experience that that's correct. But I think it's also they do care about yield. Yes.
Yeah, I'm not saying they don't care about yield.
We all know they care about yield, but what they really want is certainty. And that's the key issue that you can bring to the table by being a balance sheet lender.
Okay.
And I think that is a must. It's a must. Because what we're finding when we're speaking to potential borrowers is they'll have gone to a bank already. The bank has messed them around for so long, the time has now become critical to them. So the speed is actually enforced acceleration because the bank's, in effect, not giving them a decision.
George, I mean, you've been at the Interface has been actually at the kind of invoice funding game, for instance, for many years now.
45.
Only 45. Okay, fine. Probably even more venerable some of the institutions that our keynote speaker talked a bit about earlier. So, in your experience, is that true? You've got a lot of experience of dealing with. What do the end businesses really want out of this? Is it speed of use and the flexibility, and the yield? Does the balance sheet give you that ability to be flexible really quickly?
Since we're funding small businesses, they need money yesterday. So initially, speed is important. Yield become important after that, immediately after that.
That's number two.
After you fund them, yes. So both of it important, of course, yeah. But about balance sheet lending and hybrid model, I would like to say, we have a hybrid model for different reasons.
It might be worth explaining just exactly for those of you who don't understand who Interface is actually.
Yeah.
So what you do?
We are invoice finance marketplace or marketplace lending. But we believe in hybrid model, and the reason for that is there is a conversation going on for a couple of years about is it skin in the game, is useful or not. We on the other side of the spectrum, we're saying it's very useful. We believe in skin in the game, so even more normally we fund client first, then we put our system in inventory, and we allow investors to purchase part of it. We're always in each and every transaction with every funding with all our investors. And I believe this is a strong from the risk and credit point of view, and having skin in the game very important to us. So I think it's.
Bill, I just want to come with you, talk to you. One of the great advantages of retail is, heard about earlier, it's sticky money. And one of the disadvantages of institutional is it can move out like that. You know, they can be a bit fickle, yeah. And they can suddenly decide that actually we just don't like that asset class. So, for instance, I look at a lot of kind of similar asset classes, and classic example, CLO structures go in and out of fashion as often as as my mum loses interest in some latest soap. 1 year it's in, and then CLO. No one will touch a CLO structure in a gazillion years. So that is the real downside of balance sheet lending, isn't it? It's great having institutions that give you lines of access so that you can build the balance sheet up. But they can be incredibly fickle, and they can land your business in trouble, can't they?
Well, mine not on. There you go. From our side, where we're a fund.
Yeah, I know. Exactly.
And so,
that's what I'm pointedly asking.
Yeah. So we look at balance sheet lending. We do whole loans. We do participation loans. We do balance sheet. To us, it's about diversification. So you want to be diversified across many lending categories, geographic areas. We think structure of how you're doing the loans gives you further diversification. And it's really, from our standpoint, we have preferences, but really we meet with a platform first, see what they're like, and see what structure fits them the best. And if it's balance sheet, balance sheet to us sometimes makes it sound almost like a passive investor. Like we're just going to give them money and let them go hog wild, and hopefully we get our monthly check. I mean, there's still the same thing as if you were grabbing a whole loan and underwriting that loan. You're looking at their book constantly. You're seeing what loans are coming in. You want to review those. So in both of our private fund and the publicly traded fund on the London Stock Exchange, we're doing that. So it's really for us platform by platform. Some platforms, like I said, it used to just be we are balance sheet, we are whole loans, we are participation. They're getting more flexible, which gives us more flexibility to go in there and say, okay, let's what works best for us, what works best for you, because it really is a partnership.
come back to that in a second. Interesting enough, am I right in thinking that at Ranger, you don't invest in marketplace lending platforms?
Yeah, so we do whole loans, I mean, peer-to-peer, marketplace, direct lending. We don't do peer-to-peer. We usually stay away from platforms that have retail investors in. So we're not in Lending Club, Prosper, Funding Circle.
And what's the reason for that?
Some of it is just, diversifying away. Retail, for us, caused a lot of noise. Yeah. We want to be able to interact with the platform on their underwriting side. Yeah. We're an active loan selection fund, so we want to know what loans are there. So we want to pick up the phone if we get a loan and say, hey, we have a question on this. What's this collateral? Or we want additional collateral. So we want this interaction, and with a lot of the peer-to-peer or marketplace, it was so fast, it was very passive. They were like, take the loan or not. Yeah. So we wanted this communication. We also wanted complete transparency in the borrower information that was coming for us. So we've just stuck away. It's nothing against those. We've worked with a lot of those in our LP fund, but just the direction we've gone for the last 2.5 years has been more with direct participation with direct lending platforms.
Do you prefer, and I'll come on to talk on OnDeck's view on this, but do you prefer really doing whole loans so that you can effectively do a loan selection, so that you can see the whole loan, you can understand it, you can get a real sense of it all? Is that slightly is that your more comfort zone?
No, it's really, so you underwrite the loan and you like the loan. I mean, that's the first phase. Do you like it? And then we like the participation. Have a platform invest in us alongside of us. Their skin's in the game. We love that. If we're taking the whole loan, we like to put the platform where their service fee becomes kind of their skin in the game. If they don't perform the way they aren't, then their service fee gets reduced accordingly on it. So really, it's underwrite the loan. And then whatever structure you've set up, if it's a balance sheet, if it's a whole loan, if it's a participation, they all have their benefits. At the end of the day, you want control of that loan in case something happens at the platform level where you can rip that out. But again, the structure is really kind of after you want to like the loan first.
Zhengyuan, how do you provide people with benchmarks? So he comes along and he says, I want this kind of product and this kind of product, this kind of product, and they all have slightly different characteristics. How do you provide a benchmark for him? That's another question I've always wanted to ask.
I mean, we're in slightly a different sector because we lend to small businesses, so there's no so much of a FICO construct for people to fall in.
Is there any virtue? There is.
No, so we created OnDeck. We created OnDeck Score, which is proprietary to OnDeck. It's how we evaluate small businesses, and on the marketplace side, we very much just put rate loans into different buckets, and unlike some of the other platforms, we actually don't let people pick and choose which loans they wanted to purchase. Right. The only ability you have is really select allocation in terms of what grade of loans you would like to purchase and in what combination.
So what rate is
correct?
So that's the flow, not the credit rating.
Right, and then we randomly allocate it to our existing investors. So I think part of the how we try to put skin in the game in that situation is we still retain by far the majority of the loans that we originate. So if you look at this year, we retained roughly 80%, about thereabouts of our origination that we originated, that goes through random allocation process. So 20% of the loans we originated went to marketplace, and it's a purely random process. So you're buying a loan that's just as likely that we would own ourselves.
But isn't the problem with that random selection method that it presupposes that your loan selection and loan analysis is good? So what happens if your loan analysis and your loan selection goes off key, and basically you start lending to the wrong sector or the wrong kind of things? Basically, you're forcing your investors to effectively swallow a potential future bad credit analysis.
Well, but I think that I mean, if that's your premise,
that's the risk of everybody, to be fair.
But if your premises is that the credit modeling is wrong, then it really doesn't matter whether you're in a balance sheet business or marketplace business.
Exactly.
I think somebody on the earlier panel said something that's very very correct, which is whether you call it alternative finance, whether you call it online lending, P2P, whatever. I mean, we're still generating assets. So ultimately, you have to generate good assets to be a sustainable business. I think the other thing I'll add, which I forgot to mention, balance sheet gives you flexibility in terms of operating your business. Let's not forget that all these companies are created because bank did a horrible job serving certain markets, and we're still in an innovation business. We're still wanted to push the envelope in terms of creating new products, serving new customers, right? Now, at the same time, what you don't want to do is have a complete marketplace platform where you just create new products. And you're right, we could be wrong as part of the innovation process. What we don't want to do as a company is be innovative, but have third-party investors take that risk. So if you look at us, the balance sheet gives us a tremendous amount of flexibility in terms of creating new products, retaining that product completely on a balance sheet side of basis, test that over time, and once OnDeck becomes more comfortable with the credit risk and proven that new product is money good and sort of being the guinea pig on the assets, and then we will feel comfortable selling it to marketplace.
But Michael and Andy, to take your view on that, so I get that completely, but surely you can only prove that after a few years. You can only prove what, I mean, you guys have been around for how long now?
We've been almost 10 years.
Yeah, I was about to say, you've been a while.
But you're right.
You can only prove it after 5 to 10 years.
Absolutely.
So effectively, it goes back to something, I can't remember, any number of people have been saying, how do you, on a 3-year business, how do you prove a 7-year record? So how do you do that, Michael? How old are you? 3-4 years?
I don't know.
Yeah.
No.
So how can you prove your credit record then?
Yeah, exactly. My gray hair tells it. We launched the platform May 1st, 2015.
Yeah.
So nearly 18 months.
So in a sense, that is a live question for you. You're 2 years, a little under 2 years in, and it's great that you're putting your money on the line. Yeah, but what's your track record then?
Hopefully it's pretty good. We have a couple of my investors in the house. No, I think there's a couple of things. First is we're also in the small business world, but we're serving a very different segment than OnDeck. We're serving businesses that are in the transition from what I would call small business to middle market.
Yeah.
2 to 25 million in revenues, in growth mode, and traditionally have a pretty good history of financing in one way, shape, or form. Second is the kind of loans we're originating is the paper is quite different. We are fully secured first lien providers of capital, meaning we're collateralized against the assets of the company across the board. And I will say from an asset-based lending standpoint, there's 30 years of history. Right?
Of the asset class?
Well, of the asset class. Asset-based lending is nothing new.
No, nothing
right?
new.
And in the US, though, primarily asset-based lenders don't really go below 5 million. And we've kind of brought an asset-based lending model down market. And the market that we serve very much, to your point, which is community regional banks, branch loans, the traditional what I'll call C&I business, right? The guy who has a factory in Fort Worth, Texas, and does $5 million used to have a $2 million line with his local bank. Those days are over.
Is that? I mean,
yes.
I hear that message a lot. That a lot of people say that market above $500,000 or $1 million of loans going north, but below where the big wholesale bank lines are at 10, 20, 30, well, a bit more than that. That's the sweet spot for many people, which is in this kind of, I can give you £1 million, I can give you £2 million, I can give you £5 million. But equally, I hear that that's a sweet spot, then I hear not many people doing it, because it sounds like it's quite hard work, because you've got to go out and find those businesses, and you've got to go and hunt them down, and you're then got to do all the work on them, and isn't it a lot easier to do the marketplace model, which is just have 50 companies borrowing £50,000, rather than have 5 companies borrowing, a smaller sum. You see what I'm trying to get at? Doesn't it limit your scale in that opportunity set?
Well, I can't speak to how easy or hard it is to do $50,000 loans. I'll turn it to my friend over here. But I can say the following. The market is huge. We are the first mover in the market. We believe that we have solved a problem through data and technology that is the reason that this market has never really existed. And we'll see how it plays out. We don't disclose results right now, but pipeline is growing continuously, and we'll have to see how it goes through the vintage. But we're pretty happy with where we are, and I would say that the whole notion of cycles has come up a lot today, right?
Yeah.
We haven't seen it through a cycle, and the benefit we have is we've actually can point to not ourselves going through a cycle, but the actual credit underwriting that we use going through 4 cycles and looking at loss factors and things like that. And I think that's got people like my friend to my left and Victory Park comfortable early on.
Yeah, and from our side, one of the businesses that I'm CEO of GLI, but we've also got a business called, we branded as Sancus, which is 7 lending entities in 5 jurisdictions. And within that, one of the businesses, Sancus BMS Finance, they've been running for 10 years. They've had one default one loss of money in 10 years. So they've been through the cycle, and they're 500,000 to 5 million, and it's really IP lending. So I think you do have in this industry, there's nothing new. It's just we're utilizing technology to help scale, but it's all about credit processes, credit people. And for us, it's important that when we look at the risk, and it does always come back to risk, it's just assessing it as you would based on a sensible, pragmatic approach. So we don't use algorithms in our type of lending. We're in the average loan is around £2 million as an example. What we do is we focus on what is the credit, what's the repayment strategy, what's the security, and how we're going to get, if it does go wrong, what's the route to enforcement? And they're the kind of things that we tend to focus on. But you're right, the seasonality, the seasoned portfolios of loans, I think what we're going to see is a shift in that you'll find the institutional money wanting to take them away, in effect through securitization, from the platforms. And that's a healthy cycle, because I can see this whole platform or plethora of what we're developing as alternative becoming the feeder to the banks in due course.
Yeah,
the banks will just start to take out what we're creating because we're doing the work, and then they can package it and take it back on their books.
As you were saying it, Andy, I was when you described what you did, it sounded remarkably like what a bank manager used to do about 30 years ago. But George, I mean, you rightly look at a lot of these fresh young chickens in terms of the industry with a 45-year record and say, well, we actually do know what works. I mean, should you be focusing more on the smaller ticket sizes, the bigger ticket sizes, the more bespoke? What's in your experience works?
We saw a lot. We've been through Great Depression. But,
I got even older than I thought.
No, but I think when you look on independent specialty finance, non-bank institution, not GE Capital, not CIT size, there is always issue on a larger funding facility because of the concentration.
Yeah.
When you have a marketplace lending, you don't have this issue. You have the concentration spread from multiple investors. You have a lot of, even institutional investors that spread. You have a much stronger flexibility. On the risk, I agree. In credit, it's an old story. It's actually the biggest issue, kind of fundamental issue for us since we've been long in this industry. It's what happened for the last 10 years when a big data come on, right? It's a question. It's a big data versus collateral. Do you have if you're talking about risk, do you have a combined model, or you purely based on big data, which is fascinating. It's beautiful. Question, is it proven yet completely? We don't know yet. It's still early to say, right? So risk changing, borrowers, clients changing, economy changing all the time. We consider ourselves 45 years old startup, constantly changing. You have to innovate constantly. You have to change your credit approach. It's not that obvious everything you have to do here.
I totally agree with that, George. It's quite interesting. I have family in New York, and they're involved in data process, big data. And one of the things that Avril said to me was that she's ex-MIT mathematics grad. When she left university 20 years ago, it was really all about websites. It was the websites were the new thing. Everyone was into what's going through technology, but now it's big data. And I think the difficulty there is it's so hard to understand yet, but it is getting refined. And I think that will be a useful tool to this industry in due course. But I do take the point one of the further, earlier panelists spoke about was you just can't get dumped with a massive information.
No.
You have to have some way of slicing and dicing and making sense of it. But it does still come back to, and I keep saying this, even though we're in a technology, fintech environment, that you have to have the sensible 4 eyes or 2 eyes approach to looking at credit and saying that makes sense.
Quick question here for the audience. Bill, has deployment become harder in 2016?
Deployment? No, it's Lending Club was actually a good thing for us. From the fund perspective, I don't know if it's for all funds, but what it did was, I don't want to say tap the brakes. It slammed on the brakes of things getting out of control from the platform side of the equation, working with the investor. So, it was a joke that I think there was a platform giving us a presentation, and we said at the end of the presentation, we said, we got a question. They're like, yeah, you're out. No questions.
Really?
Because there was 10 guys behind us that weren't going to ask any questions. And I might simplify that a little bit, but it really became that. And so I think a lot of inexperienced or uneducated money left the space, which swung the pendulum back to the fund side. And so we were able to go in and negotiate better terms for us. And get things back online everything has gone great, but it tapped the brakes. I think brought it back to where it swung way on the platform side. And I think the focus on the platforms, and we've seen in the presentations, focused on getting profitable, becoming lending companies. It's a long-term thing, and that's what they need to do. And it's a big thing from the fund perspective. Are they profitable? What money's behind them? Are they always going to have to raise VC money to, and so.
Because you must care a lot about longevity of platform.
That is, because that's all our risk is at the platform level, or most of the risk is at the platform level. So we want to be profitable. We want to be lending companies, and so. So that's it. So was deployment harder? No, deployment became easier, a lot easier. A lot more deals out there, a lot more willingness to do deals to match, different fund our investment objectives.
Zhengyuan, do you want to tell us a bit more about your deal with Chase?
I think.
How does that work? Just so everybody understands it.
Yeah, so we have a strategic partnership with Chase, and basically a Chase small business customer can go online, apply for a small business loan. OnDeck's algorithm runs in the background, and we would approve a loan. Chase will actually fund the loan on their balance sheet and will retain servicing. So I think it's a very powerful tool because I think fintech has come a long way, but by and large, people still go to bank for a loan. I think it's up to all of us collectively to expand the industry. I think it was a validation for the industry overall. I think it's certainly a great thing for OnDeck, and you can see sort of the bank partnership process makes sense because bank naturally has a lot of customers. But they're not, at least in our space, they're not very efficient underwriting $50,000 loans, going through a human process. So what we're able to do is really automate that process.
Have they given you much throughput so far? Is there much volume?
Sorry?
Is there much throughput coming through? Are you actually getting much volume?
Yeah, the performance is going very well. I think both sides are very happy. Obviously, it's a very controlled launch process. You go through pilot, you go through another pilot.
Sure, very careful.
We're very optimistic. But to Andrew's earlier point, I think what's interesting is one of the very first things their credit people did is came in and sort of said, hey, here's how we underwrite small business loans. What do you guys look at? Once you sort of look through everything, we tend to look at the things that they look at. Probably more stuff, but we just use a lot of alternative data source and a lot of the source that's already existing electronically, rather than have bank tell people, hey, put together a tax return and income package and come in and we'll manually underwrite them. Ultimately it's coming down to underwriting assets, and you have to generate, whichever way you do it, you have to generate good assets.
Okay, I'm slightly aware that coffee break looms, so I'd like to put your hands together for this panel. Thank you very much.